Welcome to the Cherry Beckert Tax Beat, a conversation about tax that matters.
Welcome to this edition of the Cherry Beckert Tax Beat podcast. Today we are talking about the final regulations issued earlier this year that generated Reg 1.6011-10, micro-captive listed transactions. This regulation lays out the criteria that characterize certain micro-captive insurance arrangements as either listed transactions or transactions of interest. These designations are types of reportable transactions and require extensive additional tax return disclosures by all the involved, including related parties. Micro-captive insurance arrangements have been a hot enforcement issue for some time, and we have reached a point with this regulation that appears to sell one area of tax reporting at least. If that sounds complicated, it is. So, joining today's conversation is Rick Woods, partner and a member of our national tax team. Rick focuses on tax issues for financial services business, including these captive insurance arrangements. So, how are you doing today, Rick?
Doing well. Thanks for having me, Brooks.
And whereabouts are you sitting today?
I'm in Louisville, Kentucky. That's where I'm at. I joined the firm through the MCM transaction a couple years ago, and it's been a fun ride so far.
Awesome. And as always, joining me from Greenville, South Carolina, is Sarah McGregor. Miss McGregor, how's life treating you?
Life is good. We just went through the time change, so I'm not quite sure what time it is today, but that'll get dialed in pretty soon. I'm looking forward to some brighter evenings.
Well, and I'm Brooks Nelson, partner, normally sitting in Richmond, but today I'm down in Atlanta, and I'm very disappointed to have incredibly dismal, rainy weather when I was hoping for a little reprieve from our cold weather in Richmond we've been having lately. All right, on to the fun stuff. Just a little background. In the common fact pattern, the owners of an operating business that generates significant taxable income works with a third-party captive sponsor/manager to create and own a captive insurance company. The captive insurance company is classified as a C corporation for U.S. federal income tax purposes. The operating business receives a tax benefit by taking an ordinary deduction for premiums paid to the captive insurance company. Meanwhile, the captive insurance company makes what's called a Section 831B election to be taxed only on its investment income and thereby exclude the company's insurance underwriting income and to some degree investment income from corporate income tax. The owners of the micro-captive tax pay no tax on the income of the micro-captive until and unless the profits are distributed by the micro-captives as dividends. The micro-captive transactions result in deferral of taxable income as well as a favorable tax rate arbitrage due to the lower tax rates that apply to qualified dividend income versus insurance premiums deducted under ordinary income tax rates. So maybe said a little more simply, the operating business takes an ordinary deduction for the payments that it makes to the captive as premiums for insurance. The money stays in the captive, basically doesn't get taxed until it gets pulled back out, at which time it is taxed as a 15% qualified dividend. So you get the deferral and the rate arbitrage. All right, so let's move on to the people who really know what this is all about. All right, Rick, what has been the IRS interest and focus of concern for micro-captives? Let's hear a recap.
Yeah, the IRS is concerned that taxpayers are using these 831B captives to do things that aren't really legitimately insurance transactions. It's really just more of a savings account, almost like a rainy day fund, right? I mean, just self-insuring your own risk may not be deductible, right? There has to be risk shifting and risk distribution between unrelated parties, and maybe that's not happening in all cases. Also, you got, captives potentially insuring risks that don't make a lot of sense just to get a tax benefit. having terrorism insurance in rural Kentucky may not make sense, right? That's not really a legitimate coverage that should be insured practically. So that's what the IRS is concerned about. Just taxpayers are abusing the 831B structure, right? Backing up a little bit, without this election, insurance companies are taxable just like any other C corporation, right? They would pay tax at a 21% rate. But in this case, the insurance company is making an election to be taxed only on their investment income. They can exclude their underwriting income. So the insurance company doesn't pay tax on the premium income in this case if they've made the 831B election. So that sort of creates the potential for abuse there.
So Rick, you've used the term 831B election. Can you provide a little bit more structure around that? Is it available for anybody all the time? How come large insurance companies aren't using this?
Yeah, I mean, the reason why every insurance company doesn't make this election is that, the typical commercial insurance company outside of the captive world probably has too much premium income. There's a limitation on premiums for the insurance company. And by the way, it's not as if you can set up multiple captives and somehow get around that limitation because it's a controlled group test. So that level is indexed for inflation. It's 2.85 million for 2025. So if the premiums of the insurance company are over that, they no longer qualify as an 831B captive. So this was really created not really just for captives, or probably not really with captives in mind. It was set up by Congress ultimately to, incentivize more entrepreneurs to get into the insurance business, right? To have more insurance companies out there that would be helpful in the economy, right? And risk management, right? Having more players might bring down the cost of insurance, right? So captives have kind of taken over this election to some extent and created this sort of abuse. So
it was there originally to help small insurance companies get going by reducing their tax burden until they could, and helping them to preserve those premiums for future losses. And then once they got, up to some significant size, then that advantage would go away. They're self-operating at that point. But yeah, so the captives are really taking advantage of that.
That's correct. Yeah.
Yeah, and we'll get a little bit more into this later, but in essence, it almost feels like an awful lot of these captive insurance companies are just a subsidiary of your main company. I mean, that's what economic feels like. I know there's lots more legalities around it than that, but that at the heart of it is kind of what the IRS doesn't like about it. Mm-hmm. All right, so Sarah, you've been really tracking this stuff for quite some time. Why don't you give us a quick rundown on the IRS's enforcement efforts?
Right. Well, we first heard more about this back in the 2010 through 12, when the IRS started really auditing and going after these as an area to see what was happening. They got wind of it, and the first case that everybody points to is the Havrahami case, which was decided favorably for the IRS. And that situation had a lot of the factors that egregious factors that Rick was talking about. The coverages that weren't really appropriate, that a business would never buy in the marketplace on their own, and it was right up to that threshold limit for the amount of premiums. They were really maxing out that. And just sort of really pushing on that. And the IRS was able to disallow the premium deduction and treat that as income, taxable income to the captive insurance company. And from there, the IRS pursued that. They started putting together teams that would go after and started looking more and auditing more of these captive insurance arrangements. And in 2016, the IRS issued notice 2016-66 to say, hey, this criteria, if you have this, then we think that is a transaction of interest, and we want the extra disclosures in your tax return. And that would help them be able to find these taxpayers that were engaged in these transactions. Well, of course, there was a lot of pushback on this notice, and finally the notice was vacated by the court system more recently, and in several different directions. And then the IRS went back to go through the regular process for establishing regulations and getting comments on those regulations and then issuing final regulations. And that's where we are now. So this regulation is the replacement for the notice 2016-66 that was in place prior to this, figuring out what are reportable transactions to be reported here.
So there's been a lot about this in the news, the press, plenty of ink in the Wall Street Journal and other high-end publications about this issue. The IRS doesn't like the abuse, but at the end of the day, when we talk about 831B, we're referring to an Internal Revenue Code section, which means it's a law. The law contemplates these elections. It contemplates the existence of these type of entities. So it's all about where's the line between what's abusive and not abusive. It's not something that's wrong just because it exists in and of itself. So it can be fairly challenging in analysis. So Rick, let's get down to the more current guidance and talk about what is a illicit transaction or a transaction of interest as it pertains to microcaptives under these regs.
Yeah, as Sarah mentioned, since 2016, taxpayers that have engaged in what meets the definition of as a microcaptive transaction, they've been disclosing as a transaction of interest up till now, right? So what the IRS is doing now is potentially, if you meet certain criteria, upgrading that from a transaction of interest to a listed transactions. So we'll now have a lot of microcaptive transactions that are still going to be transactions of interest, but we may see some rise to a further level and be considered listed transactions. So to be a listed transaction, that's a higher level of scrutiny and analysis that the IRS is going to apply. But ultimately, you're meeting two different general criteria. One of which there has to be what they're calling a financing factor as defined in the regulations. What you need to think about there, the IRS has always been concerned, you've got the premium going to the captive. If the money winds up right back in the operating company through a loan or even indirectly, if they use the capital of the insurance company to support through a guarantee, like a loan guarantee, and somehow that benefits the operating company through a lower interest rate or less collateral, what have you. Basically, the concern about circular flow of funds and the money ended up back in the operating company, that's a financing factor. And if that's present, you go on to the next test to determine if it is a listed transaction. So beyond the financing factor, the other thing the IRS is looking at is the loss ratio of the captive. They're looking at the actual losses paid out by the captive as a percentage of premiums. And what they're concerned about there is captives, in a lot of cases, taxpayers that have started captives and are getting into this type of transaction will typically have a uncustomarily low loss ratio. Most insurance companies in a typical situation, commercial insurance will have a loss ratio that's much higher than what a captive would have. In a lot of cases, they're just building up reserve capital in these things, and maybe they're not even paying claims. Maybe they're not even paying, because ultimately you've got the same party controlling the captive that controls the operating company. So they may not have much of an economic reason to pay the claim, right? So therefore the loss ratio may be low. And that is kind of an indication of the IRS is maybe this isn't really insurance, right? So they're looking at the loss ratio. And if the loss ratio is less than 30% over a 10-year period, that's when you trip the listed transaction threshold. So once again, if you have the financing factor, which is the loan we talked about, and you have a loss ratio below 30% over a 10-year period, you can meet the definition of a listed transaction.
And Rick,
Yeah.
if you're just have been in existence for 7 years, then even if you're under that 30% and you have this financing transaction, you're still not a listed transaction yet.
Not yet. That's right. You have to be in existence at least 10 years to even get to that threshold of reporting, right? Otherwise, you're a transaction of interest. So what is a transaction of interest? If you have either a financing transaction, or it's not and this time, but it's or. If you have a financing factor or you have a loss ratio less than 60%, you're a transaction of interest. And that's not, you don't have to be in existence 10 years for transaction of interest. You just look at the period you have. So you can be in year 4 or 5 of running the captive and your loss ratio is below 60%, you're a transaction of interest, even if you don't have the financing factor, right? So that's where probably most micro captives that we may be seeing, I bet a lot of them are going to be still a transaction of interest, not yet a listed transaction, but we have to evaluate that.
Especially in the first year, because you clearly you wouldn't be using all of your premium capital that you received paying out on claims in that first year. So I would expect every first year captive to be a transaction of interest.
Right, absolutely.
Okay, so that's a mouthful and then some going through that analysis, very technical stuff, but let's just say you fall under one or the other of these two classifications. Sarah, what does that mean for reporting?
Well, it does mean that there's some substantial reporting that goes into the tax return and is also filed with the IRS. And that basically you're talking about the type of transaction, what's behind it. So declaring it, yes, we're a transaction of interest under this regulation. What's the benefit over what period of time? How much is invested in this transaction? And then who are all the related parties to it, and a description of that transaction. And the third area is what are the fees that you're paying to those that have helped you with this transaction? So an insurance manager, a captive manager, or a sponsor, or some other related entity or supporting entity that you paid a substantial fee to report all of those elements. And then the IRS can use that and correlate together just to find out, who are the sponsors, who are the related entities, look for those financing factors as they go forward and do their work. So just more disclosures that go in the return. That doesn't actually change the net taxable income number. It's just information for the IRS to help them in assessing and looking and determining if they want to audit or examine these transactions.
Sarah, it's probably worth saying too, who does the disclosure? The captive does it, right? Has to disclose. Also, the insured operating company files the form as well, and the owners of the operating company. So it's
and
like
of the captive if they're different. Yes, all of those related entities. So it's direct and indirect ownership needs to all disclose this transaction.
And it gets filed not only with the return, but also the initial year at least. You've got to send a copy to the Office of Tax Shelter Analysis, OTSA, which is a division within the IRS that focuses on tax shelter transactions. So that has to be filed with them as well. And I think that kind of gets you on their list, right?
Yes.
So these teams that are going to go out and audit these things.
So Rick, we've talked about the returns that have to be disclosed or the insurance arrangement, but there is a pretty good exception for that's included in these regs for what's termed customer product or service insurance coverage. You want to talk about that exception and where it might apply?
Yeah, there's an exception for product or service insurance coverage, sort of consumer consumer products exception. I've seen this a lot. The most common one I've seen is auto dealers. Now, we've got a pretty big auto dealer practice, and a lot of our auto dealers have set up captives. And the IRS wasn't typically focused on these because ultimately, what's going on, these are typically what's being insured is typically like an extended warranty that's offered to the customer, and the ultimate insured is the unrelated party, right? That's buying the car, the vehicle, right? Is ultimately who's the insured in these cases. So the IRS has created an exception, and these taxpayers do not have to do the disclosure if they meet the exception. So that's good news. And that's been spelled out in the regulations. So our auto dealers are happy. Our auto dealer partners are very happy about this. They finally have clarity on that. So.
Okay, so Rick, CFO or the business owner, is tired of reading about this on the front page of their business journal or their trade journals or whatever, and they said it's gotten too hot for me. How can they exit if they've been in one?
One thing that has happened in conjunction with issuing these regs that's really, really helpful is you can now file a very simple statement with the IRS to revoke your 831B election. Historically, you had to do that by a private letter ruling, and you were paying a user fee, and it was a much more difficult, time-consuming, costly process. Now it's a simple statement. So they've made it very easy to get out of the crosshairs here, basically, by filing this election statement. So that's welcome, because we are seeing a number of these where people are like, I don't want the scrutiny, I don't want the risk, it's not worth it anymore. We want to get out of this, and it's made it very easy. We now have a solution for that. It's very easy. So
they waive that or revoke that election to be an 831B. They go back to being a regular insurance company, paying
Correct.
tax on the premiums, less the losses, like a regular insurance company at that point.
And I think that's worth saying is, we still talk to a lot of companies on a regular basis that are struggling to manage risk. And there may be some really good reasons to form a captive that have nothing to do with taxes, right? We can't get coverage in the typical commercial market, or the coverage we can get is too expensive. And we like to do some creative things. And we do a lot of consulting. Todd Rosenbaum is here in Louisville. He leads the insurance practice along with Scott Moss. And he's very knowledgeable operationally about insurance companies, about the regulatory environment, actuarial, everything that it takes to set up and run a commercial insurance company. In fact, Todd has been involved in running several captives for clients and as a service. So he's really good, very knowledgeable. So we still talk to clients about risk management and insurance. And we typically, these days, we would probably recommend that those be 831A insurance companies, and not go through the 831B situation. It's just gotten very difficult until Congress or the courts lay out a way to do it where you can have certainty. It's probably a good idea to stay away from 831B, is my feeling. But that's not necessarily a reason not to set up a captive. There are a lot of good reasons to have a captive. So
that's right. And this regulation we've been talking about just deals with the disclosure of these transactions. It doesn't really say if they're successful or not going to be successful under IRS scrutiny. It just says, hey, this is the required disclosure. We think the IRS believes that these might be used for tax shelter purposes, and so they want more disclosure, but it doesn't necessarily mean that they are being used that way. So we do have to be cautious about how those are looked at. So.
Yeah, good point.
All right. I think that's the end of our discussion. Let's take it to final comments. So, Rick, you have any last thoughts for us?
Yeah. Once again, I think what I would say is we're approached by clients on a regular basis. I probably, maybe not every week, but every month or two, I'm on a call with a client that has been approached by someone that is marketing a captive to that client, an 831B captive. And I think these days, we're typically educating the client about what they're in for. You kind of have to know the client, because I'd say 9 out of 10 clients, they don't want any contact from the IRS. If the IRS shows up, they're not happy, and it's not a good situation. You have other clients that they don't mind, they would like to do battle with the IRS. Now that, and you have to know your client, know their how they're going to handle that situation. I think too, we got to be careful as a firm how we're involved in those situations, right? And making sure that we're not ultimately blamed, right? So we've got to manage risk for the firm in this area as well. So.
All right, Sarah.
Yes, I would say it's nice to have certainty on what is or isn't needing to be disclosed, what types of transactions. So, and I believe the guidelines are pretty clear about what's in and what's out. And the exception for the consumer product insurance, I think, is very helpful. So I'm pretty pleased with how these final regs turned out for us.
All right. So from my perspective, I'm going to follow up a little on some of Rick's comments. To me, yes, our clients really need to have a good understanding of the risk of entering into an 831B captive situation. However, I think there are definitely economic reasons for doing these captives sometimes. And again, 831B is in the tax code. So it's not like you're piecing together multiple provisions to try to get to a place that gets you a good answer that's not intended to be there. It's right there if it's done correctly. So I guess my part B to the comments is, if you're going to do it, if you decide that you really want to follow this route, you need to do it right. This is an area where you need to have a reputable manager, reputable consultants. You need to have somebody who's really doing the analysis that looks like insurance policies with actuarial tables. When you see them done right, they come back with booklets that look like a couple hundred pages thick of all this data analysis and what's reasonable premiums and all this market data. So if you're going to do it right. This is not a place to try to skip to the end of the line, cut corners and all that stuff. It really needs to be done. And I think from our firm's perspective, that's where we got to be if one of our clients is going to do it. All right, that's a wrap on the discussion for the final regs for micro captive insurance arrangements. Thank you for listening in. A quick disclaimer that we are not providing tax advice on this podcast. Please consult with your tax advisor, hopefully at Cherry Beckert, with your specific tax issues or to discuss information from today's podcast. Check out the firm's website at cbh.com for the latest guidance and materials on this and other tax and business topics. That concludes the podcast. Please like, share, and subscribe. Thank you, Rick. Thank you, our listeners, for spending your time with us. We truly appreciate it. Let's call it a day and go forth in peace.